As we head into the holiday season, the IPO market is heating up. Today we'll take a look at 5 big upcoming IPOs that we know are coming out, plus I'll share another big one on the horizon. So let's talk about doing a little holiday shopping for ourselves on this episode of IPO This Week. Welcome to IPO This Week for the week of November 23rd, 2020. Today, as we do each and every week, we'll talk about companies scheduled to go public. Most importantly, I want to give a shout out to everyone in the community for checking in and spending some of your valuable time again with me this week. And for anyone new here, my name is Kevin, and I want to welcome you here for the first time. Now, with Thanksgiving occurring this week in the US, we only have one company coming out. So I thought after we go over that one, we could talk about some of the big IPOs looking to hit the market as we head into a holiday season like no other. And to do that, I'm going back to my childhood when I made my wish list for Santa. And my wish list for this year will have some unicorns on it. The biggest upcoming IPOs looking to round out the year 2020 in what we know so far. And I'm sure many of you know the names: Airbnb, DoorDash, Affirm, Wish, and Roblox. Let me know in the comments which of these companies you're most interested in. As you've seen before, the ones that get the most votes tend to get the more videos. And there's another big company out there we'll touch on as well, one I'm sure you heard of, but they haven't filed for an IPO yet. But that doesn't mean we can't start thinking about it. So stay tuned for that, and also a plan I have for some upcoming live streams, something we haven't done for a while, but something I really enjoy doing. Up front, please know or remember that I'm not a financial advisor, and while this video is meant to be informative, it should not be seen as a recommendation for you to take any action on the companies covered. You should always do your own research or consult with your own financial advisor when making any investment decision. Before we dig into our holiday wish list, let's do our normal business and quickly talk about the one company actually coming out this week, and it's a Russian one named Ozon Holdings, ticker OZON. This company has been dubbed as the Amazon of Russia, as the company says it's the most recognized e-commerce brand in that country, with them reporting a top-of-mind awareness of 32% compared to 18% for the nearest competitor as of June of this year. The company has been unprofitable, but has shown good revenue growth and has benefited from the pandemic, also a similarity with Amazon. The market is growing in Russia. However, as an investor, you do have to consider the risk of the different accounting standards and the effects of currency depreciation when investing in companies there. If you're interested in the company, Ozon's IPO is set to be priced between $22.50 and $27.50 on Monday, with trading to begin on Tuesday the 24th. And now to what's really important, my shopping for myself IPO wish list. And I have to let you guys know up front that as of right now, we don't have an exact date for when trading begins on any of these companies. When we do, I'll let you know, and to make sure you don't miss it, you might want to turn those notification bells on, okay? Alright, so with that out of the way, let's start off with what most people would say is the biggest name on the list, Airbnb, who dropped their widely anticipated filing last week. And right after they did, we took a pretty thorough look into what was in their filing in a video I put up last week. If you haven't seen it, definitely check it out. I'll link it in the description for you. I'm not going to go over everything in that video, but I do want to talk about some of the more important information that we got and how that might impact our buying strategy. The main thing and I'm sure many of you were looking to see, was how the company responded to the pandemic and what that could mean going forward. And Airbnb didn't disappoint, as they provided us some data on how their bookings were affected this year on a month-to-month basis. After everything basically shut down by the end of the first quarter, Airbnb did have a recovery in bookings through July, where they recovered from 8.7 million bookings in April to 28.3 million. So that was a strong rebound that was primarily driven by people vacationing closer to their homes and outside of the more typical tourist spots and cities. But after July, as you can see on your screen, the numbers start to drop again, with 26 million bookings in August and then just 23.9 million in September. Now your first thought might be, that could be a typical winding down of the summer season, where vacations are wrapping up as families with kids prepare for the start of the school season. But when you consider that September has Labor Day, historically a big travel holiday in the US, and also compare where bookings were in October of last year, you can see that the decline is more than just from the ending of the summer season. And with a surge of infections in the fourth quarter, it's likely that the booking numbers could continue to go down. So we can expect some more drops in revenue, which obviously isn't optimal as Airbnb heads into their IPO. And as I mentioned in the video reviewing the filing, the company is already projecting to expect year-over-year declines in nights and experiences booked and gross booking value in the fourth quarter than in the third quarter, as well as increases in cancellations. So you have Airbnb, arguably the biggest brand looking to IPO on this list, looking at a potentially rough first couple of quarters as a public company. If they were looking to go public a year ago at this time, you would be looking at great growth in bookings and revenue and evaluating that against high expenses and the challenges of having different locality regulations. Now with the pandemic, you still have the expenses and regulations, but you're also looking at declining revenue and bookings. So you think, why would they do this now? Well, the biggest reason appears to be stock options for their employees, and they need the liquidity of the public markets where the employees can start seeing some cash. But as an investor, with the current conditions being what they are, does it make sense to buy once they start trading? I'm still coming to that conclusion myself, and I'll make a video on that right before the IPO happens where I'll share my thoughts and analysis. But to let you know where I'm at right now, I'm in a cautious mode where I might be leaning to watch and wait instead of jumping right in. I'm usually looking at the long term, and long term I think it's a company I would want to own. I'm just trying to balance that out with thinking if I could get it in at a better price by waiting. But that's to be determined, and I'll update you on my thoughts again in a comprehensive video on the company that I'll put out right before it starts to trade. When it does start to trade, it will be under the ticker ABNB. Moving on is the second company on my wish list, which really is in no particular order, and that company is Affirm. Affirm is interesting to me in a couple of ways. One is that the industry it's in, that being financial technology, always an area that piques IPO investors' interest. The second is who helped found it, Max Levchin, one of the members of the now infamous PayPal Mafia, the group of people who made PayPal a success before moving on to start other companies. And some of those names include Peter Thiel, who we talked about when Palantir went public, and then there's that rather boring guy you might have heard of named Elon Musk. Now with this background, you can see why Affirm made the list, but you might be asking, as a business, what do they actually do? Well, the gist of it is that their platform allows people to buy things and make payments in installments. Okay, and that probably leads to your next question, which is, so they're basically a credit card type of company, right? And to that question, the answer is that yes, in a way, but they do it very differently. So typically with a credit card, as you know, you buy something, and if you don't pay it off in the grace period, you pay interest on it that compounds, meaning that every month not only are you paying the interest on the initial price, but also on any interest that is carried over from the previous month. And if you pay late, then you're assessed late fees. So that's a typical traditional model. Instead, what Affirm is doing is telling you up front how much you will ultimately pay using simple interest. So when you're ready to buy something like shoes, which is the example from the company, at the time of sale, you are told up front what you will ultimately pay for it within a time frame that is agreed upon. The balance on what you owe doesn't go up if you miss a payment or if you elect to pay it at the very end of the term. So in the example, you can see that you can end up paying a lot more if you use a traditional credit card. Now we all know the best way to use a credit card is to pay your balance off every month so you don't have those finance or interest charges, which is what I do. So Affirm isn't a product that I can see myself ever using. However, we realize that so many people do use a credit card by paying their minimum balance that, while not as good as paying no finance charges, the option of Affirm could be a good alternative to using a traditional credit card. So that's the innovation the company is bringing to the market. Now from a financial perspective, they're growing fast. For the fiscal years ended June 30th for 2019 and 2020, their total revenue had a year-over-year growth of approximately 93%, reaching $509.5 million as of June 30th of this year. What's interesting, and what I would say is also a little concerning, is that of that revenue, 28% comes from Peloton. So that's a lot of concentration in one customer. But then back to the positives, another one is that losses were down slightly in the same time period, with Affirm reporting a net loss of $112.6 million in the 2020 fiscal year as compared to a $120.5 million loss in 2019. So on my list, I'm writing AFRM, the ticker symbol that Affirm applied to list under on NASDAQ. As we get closer to the eventual IPO, I'll share more information on the company as I have it. So if you haven't subscribed, definitely consider doing so. That way you won't miss anything new that comes out that I can share with you. And that reminds me, if you're enjoying this video so far, please hit, smash, or even tickle that like button. It's so important in letting me know that you like videos on upcoming IPOs, as well as helps grow the channel. YouTube really values your engagement, so when you like the video, it sees it as one that will push out to more and more people, which will in turn bring more people to the community, and those people can add even more value to the great discussions we have in the comments. So thank you for helping me out. Okay, let's move on. For those celebrating Christmas, you might be familiar from a line in the Rudolph song that says, "You know Dasher and Dancer and Prancer and Vixen." Alright, I'm going to stop there before I break into song, since my own family criticizes my musical abilities and I don't need any more heat here in the comments. But I think you see where we're going. We're talking DoorDash next, the company that allows you to get food from your favorite restaurants to be brought right to your home by Dashers, what the company calls the independent contractors that actually deliver the food. Like Airbnb, this is another company we've talked about the day their filing came out, where we went over the biggest details of it. So if you're interested in DoorDash and missed that video, I'll link it for you in the description. Again, I'm not going to repeat everything from that video, but I do want to hit some of the major highlights and talk about some considerations of it. One of the big highlights from their filing is how much the company has grown its revenue and market share. From a market share perspective, I don't know about you, but I was pretty surprised to see over the past couple of years that the company's share of the market grew from just 17% in January of 2018 to the 50% that they're at today, considering they have some other well-known brands competing with them in Grubhub and Uber Eats. What this screenshot shows is that, of those three companies, DoorDash is executing much better than its competitors when looking at gobbling up market share. And its revenue has grown along with it. First, for all of 2019, DoorDash reported revenue of $885 million. And then in just the first 9 months of this year, they generated revenue of $1.9 billion, more than double the amount in just 75% of the time. Now, as to the timing of the filing of their IPO, probably more than any others on this list, they had to be waiting to see how the election turned out. But not because of wanting to see who would be president, but because of wanting to see how Proposition 22 turned out in California. In the state, voters passed the measure which allowed Dashers to continue to be classified as independent contractors, and therefore keeping the company from being responsible for all the regulations and costly requirements that having them labeled as employees would bring. This was certainly a big win for companies like DoorDash, who fought aggressively to get the measure passed. Now going forward, there are two big considerations I'm trying to wrap my head around with DoorDash. One is how much of their growth was a result from the pandemic, and with that, how much of that will it last once the pandemic is over. The company has shown that prior to the pandemic, that once people begin using the platform, they tend to continue using it. So that helps to address that point, but ultimately we'll have to see how people's long-term behavior changes once things get closer back to how things were before. The other consideration, and what I feel is the bigger one, how does the model make sense for all three pieces of the puzzle? That being the restaurants, the customer, and the Dashers. And what I mean is, how can it be a win-win-win for all three? For instance, if the price for the delivery is low, then the customers win, which will lead to more orders for the restaurants, so they win too. But to keep the price low to drive the orders, then the Dashers might see less money, resulting in less people willing to deliver or choosing not to deliver at special times or specific locations, resulting in a poor experience for the customer and the restaurant. To keep the Dashers happy, they have to be compensated at a level that makes it worth their while, which would likely result in higher delivery fees, and that in turn could turn off some customers from using the service. So it's a tough balance and the biggest consideration I'm working through. I know DoorDash is looking at things like drones, but that's not something I see as being immediate, plus I think that brings its own questions to the model. As we get closer to the company starting to trade, I'll share what I've come up with, so stay tuned for a comprehensive video on DoorDash that will cover that as well. And like how I'll do with Airbnb, that video will come out right before the company starts trading, which will be under the symbol DASH. Up next, what wish list for the holidays doesn't have games on it? So to meet that very important criteria, we have Roblox to satisfy that need. Roblox is among the world's most popular gaming sites for children, and not surprisingly, has experienced big growth during the pandemic. In fact, its daily active user base jumped 82% to 31.1 million in the 9 months ended September 30th from the same period a year earlier. For some background on their product, the Roblox platform is composed of three elements. First is the Roblox client, which is the application that allows users to explore 3D digital worlds. Next is the Roblox Studio, which is the toolset that allows developers and creators to build and operate 3D experiences and other content accessed with the Roblox client. And then there is the Roblox Cloud, which is the infrastructure that allows users to experience the platform fully and together. So how it works is when users sign up for Roblox, they can create an avatar and explore the vast majority of the game experiences for free, although the business model for any given experience is ultimately up to its developer. Most free experiences allow users to spend what they call Robux by purchasing experience-specific enhancements. Users can also use Robux to purchase items such as clothing accessories and simulated gestures from their avatar marketplace. Roblox retains a portion of every Robux transaction and distributes the rest to its developers and creators. Users can buy Robux in two ways, as one-time purchases or through Roblox Premium, a subscription service that is billed monthly and includes access to exclusive inexperienced benefits, discounted marketplace items, and the ability to buy, sell, and trade certain avatar items. To capture that revenue, Roblox accepts payments through app stores, credit cards, and prepaid cards. From a financials perspective, revenue grew 139% in the year ended December 31st, 2018, and grew another 56% to $488.2 million in 2019. And more recently, revenue grew 68% to $588.7 million for the 9 months ended September 30th, 2020. So this year has already surpassed total revenue for 2019, much like what DoorDash did. Now this, of course, doesn't mean that the company is profitable, which is the case for the majority of IPOs. From 2018 to 2019, Roblox actually did cut their net losses down by over 10% to $86 million. However, their net losses grew substantially through the first 9 months of 2020, reaching a loss of over $203 million, so the trend from the previous year wasn't able to be maintained. Again, we don't know when trading will actually occur, but when it does, it will be under the ticker RBLX. The question we'll have to answer for ourselves on Roblox is if we think it can retain the gains in usage from the pandemic and continue to grow upon them. Now, before we talk about one big company that is lurking out there that is yet to publicly file for an IPO, we have to finish up our list with another unicorn that we know for sure will be IPOing soon. And what better company to finish out that wish list than one named Wish? Are you booing me out there? It was just too easy to pass up. So what do we know about Wish? Well, the first thing is that they filed under their parent company's name, ContextLogic. But as to Wish itself, it's a fast-growing global e-commerce platform that connects more than 100 million monthly active users in over 100 countries to over 500,000 merchants offering approximately 150 million items. The company was founded in 2010 to focus on a platform of China-based merchants, and while they have expanded that reach to more countries, most of the merchants are still based in China. And because their platform was built for mobile users, they didn't have to adapt an existing PC platform for a mobile experience, unlike a lot of other companies had to do. Financially, they're growing, and as you can expect, with the type of business they run, much like Roblox and DoorDash, they've thrived in the pandemic environment, with revenue rising 32% year over year when looking at the first 9 months of 2020. And the market opportunity appears to be out there to keep growing. Based on a market research report Wish cited in their filing, global e-commerce was a $3.4 trillion market in 2019 and is expected to nearly double that and reach $6.3 trillion by 2024. And within e-commerce, mobile, which is where Wish's focus is, consisted of 63% of global e-commerce in 2019, a number that is expected to grow to 71% by 2024. Now, needless to say, they have competition, and they listed some of them, including heavy hitters like Amazon, Alibaba, and Shopify, the names you would expect from that industry. And they also consider discount retailers like Walmart and Target as competitors as well, as they also mentioned them in their filing. If Wish's IPO is on your wish list as a gift for yourself as well, they'll be easy to find on NASDAQ. Yep, you just look for the ticker, WISH. Simple as that. Okay, so those are the 5 companies that have filed for their IPOs of this recording. Again, while we don't know the exact dates as to when they will trade, we're expecting each of them to go public by the end of the year. As they get closer, and as they release filing addendums where they give us the expected dates and pricing ranges, I'll be sure to cover them when they come out, so definitely stay tuned to the channel. And by the way, please remember to let me know which of the 5 companies you're most interested in the comments. I really like knowing where the community is at. Now, what about that big old unicorn I keep alluding to that hasn't yet filed? I'm thinking some of you have already guessed it because there's been a lot of anticipation for it. It's another company that has also benefited from the consumer changes brought forth by the pandemic. And not to drag it out any further, that company is Instacart. With Instacart, we feel it's a matter of when, not if the company will file. But of course, the later they wait, it's more likely they'll get pushed to 2021. Just from some comments in other videos, I know a lot of you are interested in Instacart, and for good reason. Their business has been tailor-made for today's current environment. And in case you're not overly familiar with Instacart, they are a company that operates a grocery delivery and pickup service in the United States and Canada by way of a website and mobile app. Their service has now expanded to operate in all 50 states of the US and allows customers to order groceries from participating retailers with the shopping being done by a personal shopper. So with the ongoing concerns of the pandemic, particularly on those more at-risk populations such as the elderly and those with comorbid conditions, the company provides a solution that allows these people to get the items they need in a much safer manner. And with cases surging as we head into the winter, more and more people, even outside of those higher at-risk populations, will likely continue to use the service. Now, as to what we're interested here in this video as far as the company going public, what do we know so far, and why do we think that the company will IPO in the near future? To answer those questions, it's been reported that Instacart has selected Goldman Sachs to head up and lead its IPO. So that's a pretty good indication an IPO could be imminent. And second, like DoorDash, they too were at risk if Proposition 22 failed in California, where they would have had to classify their shoppers as employees and the costs that go along with that. And so now that that hurdle has been cleared, it makes an impending IPO more likely. And really, it just makes sense with the current state of the world. I mean, who could say otherwise? The perfect opportunity and timing is right there in front of them. Most recently, Instacart was valued in October at $17.7 billion, and an IPO would expect to lead them to a $30 billion valuation. This company will bring a lot of interest, and so while I may not have the opportunity to buy it for myself over the holidays, I can still have visions of sugar plums and Instacart dancing in my head. I better stop here before you turn that thumbs up upside down. Alright, so there you go. 5 big companies that look to go public by the end of the year, and one more big one that we're waiting on. I hope you feel I delivered what I promised to share with you in this video. And since it's going to be an exciting time in the IPO market, I'm thinking about having some live streams after the first days that some of these companies start trading, so we can discuss together in real time what happened on day one. So while I think it'll be exciting for IPOs, it'll also be an exciting time for the channel. I really hope everyone enjoyed this video, and if you did, please remember to like it, comment on it, and share with your friends, or even share the link to your social media sites. After all, the more we grow, the more we can and will do here. And if you're new to the channel or just an occasional visitor and haven't subscribed yet, I'm personally inviting you to join us. After all, it's free and it's super easy. You just got to push that little red subscribe button. And once you're in, you'll be sure to keep up on all the upcoming IPOs by watching our weekly featured show, IPO This Week, as well as the more analytical videos that I put out on some of the companies that investors have a lot of interest in, like most of those we talked about today. I know I'm biased, but after getting a lot of feedback from many viewers, I feel this channel is a combination of the best and most concise way to stay up on all the companies going public without me trying to sell or push anyone on a company. And I'm always working to try and make it better. So hang in there with me as we round out the year and look forward to hopefully a much better 2021. But for now, let's wrap it here. Thank you for watching, and until next time, have a great day.